everyone's trying to figure out how all these puzzle pieces come together. And I'm not sure any of us here have the answer, but we're closer to the answer today than we were 3 or 4 years ago.
In this episode of Investors and Operators, I am sitting down with Aaron Kless, Managing Partner and CIO at Andalusian Credit Partners, and Joe Weissglass, Managing Director at Configure Partners. This is going to be a deep dive into some fun topics that are happening in the credit markets. Who should listen to this? Who should pay attention to what is going to happen if you are a private equity firm or you're a privately held company with or without any type of relationship with a private equity firm? This is for you. Some of the topics we're going to be covering are, what are some of the lesser known insights into credit markets that we need to keep in mind for the next 3 to 6 months? What are the key factors driving an active, hopefully, M&A market on the second half of this year? What do RIAs need to know about this asset class within private credit, and many more topics? So I will pause there, turn it over to these awesome guests for a little bit more introduction on what you guys do. And I would love to start off with Aaron and then over to Joe.
Great, thanks, Jordan. Great to be here. Just a quick overview on Andalusian Credit Partners. We're a middle market direct lending firm. We focus on senior secured loans to middle market companies. So for us, those are borrowers with, say, 10 to 50 million of EBITDA. We finance both companies owned by sponsors or private equity firms, as well as independent companies or non-sponsored companies. We do have a little bit of an industry focus and some specialization, but we are generalists. Our 3 areas of focus are sports and sports-related businesses, media and entertainment, and what we call financial and specialty services. So think business services, tech-enabled business services, often with a financial slant, meaning to the financial industry. But really beyond that, we're generalists, and we've got long histories investing across industries across the U.S. middle market.
Great. Joe, over to you.
Thanks, Jordan. So here at Configure Partners, we're a debt advisor. We work also across all industries, really have no focus from an industry perspective, but we do focus solidly in the middle market. For us, that's borrowers, probably $10 million of EBITDA on the low end, up to 150 or so on the high end. So think of us as really being your private credit specialist, your advisor to help both sponsored and non-sponsored businesses find the right lenders, the right terms, the right collection of terms and credit agreement in the middle market. We have about 25 professionals, all focused on the same thing, most of us out of Atlanta.
And just for a little bit of background on kind of how I know each of the firms, Andalusian is a client of 51 Labs, for disclosure, and Configure has been a donor to one of our nonprofits and a big supporter in the Atlanta area for 51 Vets. And we appreciate you all being here. So let's go to this first question. Let's make it fun. Let's make it juicy, potentially a little controversial. What are some non-obvious insights on where these credit markets are going for the next 6 months to 12 months? What's your view on the world here? Starting off with Mr. Kless.
All right, put me in the hot seat. Look, I think one of the things that we talk about a lot and we think about a lot with our current investors, with prospective investors, with our borrowers, whether they're sponsored or non-sponsored, is just how complex and nuanced, the private credit market is. The upper part of the market, the core middle market, the lower middle market, those are really just so different. Each of them is so different in the way that they behave and the opportunities that are out there for us as a lender, for Joe and Configure as a debt advisor, but for borrowers as well. The upper part of the market is pretty crowded and pretty competitive, and you see a lot of activity, particularly here in the beginning months of the year, and I suspect it's going to persist into the second quarter. A lot of bank activity, a lot of BSL, CLO activity. You see that in the technicals, you see that in the CLO flows. Whereas the core middle market, where the bulk of our business is, doesn't have that, right? That's not a market that's served by liquid credit or BSLs. So a much different market. It's a little bit higher coupon market for our borrowers. It's a little bit tighter terms for our borrowers, compared to what you might, open up the paper or read about where the credit markets are, right? The story, I think, today is credit markets are flush with cash, hyper competitive, spreads are compressing, structures are getting loose, leverage is ticking back up. And I'm just not sure that that's true in every part of the direct lending market. So from a borrower's perspective, I think it's good to understand that where you fit into the market might not be what you're reading on a day-to-day basis. And from a lender's perspective, it's something we have to keep a close eye on. Just because a big deal gets done on certain terms doesn't automatically mean that that's going to transmit into the market that we play in.
And I swear we did not compare answers to this question before logging on. But I'd say something similar, right? The market has been more dynamic over the last 6 months than over the last 6 years. I think it will be more dynamic over the next 6 months than it has been in the last 6 months. And that means that the lenders who were most risk on 6 months ago, it's a different set of lenders today, and it will be a different set of lenders 6 months from now. And being on top of that, really, it's our job as far as advising our clients to the right lenders, the right opportunities, the right lenders. And I think one of the major drivers of that dynamic ecosystem, really, particularly looking forward, is the broadly syndicated markets. They are going to open back up. And what that means is that all of the mega lenders who have been providing credit to borrowers who really historically have been broadly syndicated issuers, those lenders are going to get pushed out of that market. It's impossible for them to compete with liquid credit markets. What does that mean? They still have capital to deploy. They are coming back down into what I would call the core middle market. And that ecosystem is going to shift all over again. And lenders are going to get pushed around and jumbled around and refocus as far as where they want to play once those markets do open back up.
So history doesn't repeat itself, but it often rhymes.
That's right.
What is this rhyming with in the past, and what have we learned about the past, and what borrowers, maybe sponsors, should be thinking about, going into this next cycle?
That's a great question. It rhymes a little bit to me with the immediate period post-COVID. I don't know that I can look back to the global financial crisis just because the credit markets are so different then than they are today. But for me, the period immediately post-COVID, where we came out relatively suddenly, came out of a period during COVID where the markets were completely backed up, completely frozen, and then suddenly everything broke loose, and it all broke loose basically at the same time. And I know anybody in the deal world just spent the next 18 months running as fast as you possibly could. And that really was the onset of a lot of that dynamic nature in the credit markets, I would say, as well. So I think this, to me, rhymes a little bit with the immediate period post-COVID, where we come out of this credit freeze on the liquid credit markets. We come out of this credit freeze. And again, I think we're going to be off to the races as far as how is all this capital deployed, and where is credit focused and not focused?
Yeah, look, I agree, Joe. I think those are great observations. And I think the key word there is just dynamic, right? The market is so dynamic right now, probably more dynamic than I've seen it in my career. So, in terms of, looking back at history and what are the analogies here, I just think that we're in the early innings, but not the first or second, maybe now the third or fourth, of really the maturing of the direct lending industry. We've seen the big lenders get so big and so institutional. And I agree with you, Joe, we're going to see a lot of reshuffling as the syndicated markets come back. A big theme that, you can't look on any your favorite financial news source and not see, some bank trying to do a tie-up with a private credit lender. Everyone's trying to figure out how all these puzzle pieces come together. And I'm not sure any of us here have the answer, but we're closer to the answer today than we were 3 or 4 years ago. And I think ultimately this market is going to start to look more like the syndicated markets. There's going to be more transparency. There's going to be more liquidity. And, look, ultimately that'll be good for borrowers. That'll be good for the industry, at writ large, but it's going to require some pretty fundamental changes as well.
So let's kind of unpackage that a little bit more. You're both saying it's dynamic. What does this actually mean for borrowers? And let's say businesses that are, 10 to 25 of EBITDA, maybe even down to 5. Like, what does this actually mean and how they need to think about their portfolios, how they need to think about M&A activity for the next quarter to 2 quarters?
Yeah, look, when I think about dynamic and that word, particularly at that lower end of the market, it has a lot to do with who are the debt capital providers, right? So we've got a whole shift going on with commercial, mid-market, regional banks, right? Everyone knows the story of 2023. That story is not over, right? There's more of that to play out. There's pressure from shareholders, from depositors, from regulatory, regulators that are continually changing those behaviors. Whether mostly for non-sponsored borrowers, right? Your typical founder-owned $5, $6, $7, $8 million, whatever widget manufacturer who got a leverage facility or some kind of a bank line from their local bank, right? That's changing, particularly as M&A, and I think Joe and I agree, right? We're going to see an uptick in M&A volume, sponsored for sure, but non-sponsored as well. So I think the lesson for them, or the question for them, when you think about that dynamic nature of it, is who are the lenders that are playing in their market? Who can they go to for debt capital, right? Is it the local bank, or is that no longer a really accessible source of capital? And if it's not, how do you get to the non-bank lenders, right? We don't have a branch,
Yeah.
on Main Street.
Well, let's double click on the part about the 2023, because maybe people in the privately held companies who have never had a private equity interaction might be less familiar or not as up to date with what's actually happened in the regional banks. So maybe Joe, can you kind of paint a little bit of picture? What happened in 2023? What's that carryover to this year? And what does this actually mean to that privately held company that has 5 to 15 million of EBITDA, never had private equity ownership? But what happened and what does this mean for today?
Yeah, look, I'd say historically, commercial banks played a huge part in middle market credit. They always were a low cost, typically lower leverage, but lower cost solution for the average middle market borrower. You hit SVB and all of the post SVB turmoil, and you can see in the data that the banks rotated very swiftly out of being risk on. They were not making loans, and what makes this very challenging for the average borrower, and even for private equity backed companies, is they don't throw up a closed sign on their front door, right? They don't turn off the lights. They still act as though they're in business, and it's their job to do that. But there's a lot of long, slow no's when it comes to making new loans, issuing new loans. And that's continued through all of 2023. There's been a degradation, not an improvement, a degradation in sentiment across commercial bank land. And it's really not until the last quarter that we start seeing some stability, even not a reversal, just stability in sentiment from commercial banks. I don't think, and they still aren't, I know they aren't. I don't think that commercial banks are back in the market of really, really, truly lending money in the way they used to, maybe ever, but certainly not in the near term.
So is the takeaway here for these privately held companies, you might think you're going to get a process done soon, but it's going to be a heck of a lot longer than what usually happen in the commercial banks. So parallel that process with private lenders.
And you might get to the end of that long process and hear no, unfortunately. And that's when we run all of our processes. Yes, we include commercial banks. The hit rate is incredibly low with commercial banks. And then you've got private credit alternatives, right? And there's a bunch of different flavors of private credit alternatives, ready and waiting to go ahead and pivot to that solution.
Yeah.
Yeah, look, I think the message to those borrowers is, call Joe, right? Like just going down to the bank, your old banking relationship isn't going to work. You need a firm like Joe's. You need Configure, someone to help you figure out what's out there, what's in the market today, what's the art of the possible, what it's going to cost, what are the the pros and cons of it. Call Joe.
So let's shift a little bit over to RIAs. And can you kind of talk about maybe the evolution of RIAs and their high net worth clients that have come into this market? What are maybe some of the misconceptions or just unknown things that RIAs ask about with this asset class that they need to know to educate their client base? And Aaron, if we could start with you.
Sure. So, look, RIAs are, in some respects, they're the new kids on the block as an investor in the asset class. And in some respects, they're the next frontier, right? So as alternatives as an asset class in total grows, a lot of that growth is coming from retail investors, right? I mean, there's sovereign wealth funds and there's pension funds and there's endowments and all that kind of stuff. But really the next frontier, writ large for all of alternatives is retail. And a lot of that's going to come through RIAs. So they're pretty, or the ones that are in the game are early to the game. So it requires, as an asset manager, it requires a lot of hand holding. It requires a lot of education, but that's part of our job. So there's nothing wrong with that. And look, I would say some of you asked about, misconceptions or the learning points. I think one of the big things is, what I'll just call the relative value trade. So, a high net worth individual might today in this market, or let's rewind the clock actually a few months to make the example a little bit more dramatic. I can go into and buy liquid credit and construct 10, 11, 12, 13, a few months ago, 13, 14% yield. And with liquidity, or at least the illusion of liquidity. You're going to come into a private credit fund, obviously there's some public BDCs out there, but generally speaking, these are illiquid structures or limited liquidity structures. And they're really I think they're more appropriate from an RIA or a high net worth perspective, part of an overall portfolio that's constructed, kind of reasonably to have liquid credit exposure, but also private credit exposure. We've got longer duration. You're trading, duration for liquidity. But generally speaking, pretty meaningful premium from a spread or a yield perspective. And maybe over the last few months, that relative value concept hasn't really, it hasn't really proven true over the last few months. But if you look at it over longer periods of time, it's as plain as day. So I think that's one of the challenges with RIAs and high net worths. And if they've just come into the market, they just need to understand that, to Joe's point about the rest of the year and things being very dynamic and the health of the BSL market, what that's going to do is compress spreads for liquid credit, right? That level of enthusiasm and competition. And you're going to start to see some of that premium come back into the private credit markets, which is what these high net worth investors, these RIAs, should be focused on.
And I'd say a very similar answer, at least in the conversations I've had though with RIAs, there is a misconception that all private credit is middle market credit, and they want to paint the asset as though it's a single thing, and it's really not a single thing. There are the major mega funds, and they may as well be alternatives to broadly syndicated liquid. And as an investor, as an RIA, you really should expect a relatively modest or even relatively low premium relative to liquid credit if you're investing in the megas, right? You come down market and select a GP, select a manager that focuses on a down market, more truly middle market piece of the business. And yes, you should see a real premium there. Those are smaller businesses. You get better protections from covenants and the structure perspective as well. And then you can take that all the way down the size range to a more extreme, lower end of the middle market, $5 million EBITDA businesses. And those are different places to invest as an RIA. They are not the same thing. And we haven't even talked about the fact that there's non-senior private credit lending funds out there as well, right? Which have a completely different yield profile. But because they are the new kids on the block, because they're learning, they're getting exposed to this asset class in real time, and it's very dynamic at this moment. I don't blame them for not understanding all the puts and calls, but there's a lot of nuance that the average RIA doesn't yet really grasp.
How much have RIAs come into your discussions, Joe, where you might be looking at a particular deal and just talk to the funded firms like Andalusian and others, as opposed to to what extent are family offices, multifamily offices, RIAs coming into your lender list?
Very, very seldom. The funded guys are the guys who can move predictably and at the pace that we need them to move to close a transaction. RIAs, when we interact with them, it's because they're inbound to us asking for intel on private credit, and that's the extent of the exposure to them. And your family office investors, while they will all tell you that they want to control their investments, they want to make their own decisions about where they're investing, almost none of them are prepared from an infrastructure perspective to evaluate a direct investment without locking arms with somebody like Aaron to help them along the way. They just don't have the structure to do that.
Yeah, we see the same thing, Jordan, talking with family offices. And look, and family offices also aren't a monolith, right? There are huge family offices that are highly institutionalized, but the average high net worth kind of family office that maybe has left the RIA channel because they're now big enough to sort of do it on their own. I couldn't agree with Joe more. They love to understand and ask about, direct investing opportunities and co-investing opportunities. It's just really hard, right? The pace of deal flow in private credit, I should say in direct lending specifically, it moves pretty quickly, right? It's not as fast as liquid credit, but the average deals start to finish from our perspective, right? So longer from Joe's seat, right? He gets into the flow earlier, anywhere from 1 to 2, maybe 1 to 3 months, 1 to 2 months on average. That's a pretty fast decision to make from, inception to literally sending the wire. And a lot of family offices just don't have that level of staffing, infrastructure, and scalability.
Moving over to a topic of GP-led continuation transactions. Joe, you had an article in Q1 of 2023 that was talking about how these close rates were 75%, and now they came down to like 40%. That was a year ago. Where are we at today? What are you guys seeing?
So I think things have improved marginally, I would say, as far as close rates. So we're north of 40%. These are still challenging times to go on average put together a continuation vehicle that works. And that's the important element of this, is that most of your continuation vehicles, they are constructed at a discount to the net asset value from the private equity, the GP's perspective. And candidly, oftentimes that discount is too great for that transaction to work for the incumbent LP base, for the incumbent GP to then move forward with the continuation vehicle. I think this is probably exacerbated by, the denominator effect, as it's been called, right? And as capital flows increasingly to continuation funds, which it's doing, there's no doubt about that. And LPs start receiving distributions from their traditional private equity investments. I think you will see that bid-ask spread, if you will, that will compress, and you'll see improvement in this market going forward. But it's still relatively tough right now.
For what it's worth, on the continuation fund end, we don't get involved in the financing of the transfer to the continuation fund. But I'll tell you, just in these first kind of whatever it is, been 2.5 months of the year, I think we've seen three three borrowers looking for refinancing, dividend recaps or just regular way refinancings that are held in continuation funds. So there's a growing number of them out there for sure.
Go ahead.
As I just one other trend I'd point out it's very, very nascent, but if you look at continuation vehicles, effectively an equity secondaries transaction, which I do, I think credit secondaries, which is effectively a multi-asset continuation vehicle for credit funds, that's going to be a big story over the next couple of years that I don't think is getting much attention right now.
I 100% agree with that. I get a lot of people asking me questions about that. I couldn't agree with you more, Joe. I think that's kind of, yet another kind of asset class that's going to mature and evolve. The folks I know who have been around that to date, it feels like it's been a little early, but I think some of the market dynamics and that denominator effect that you referred to are going to really wake that market up in the next couple of years.
So kind of another high level question, but you've been on the same page on a lot of things, but let's find some fighting words. What are some things that maybe you believe individually or as a firm that you believe to be true, but others doubt about the credit markets? Let's start things up a little bit.
Who's going to start? Aaron, you want to start? You want me to start? Who's going
Here's
to
the
throw the first
bus.
punch?
Here's the bus.
So look, I mean, I'd be curious to get your thoughts on this, Joe. So, one of the questions we get all the time is, are some of these lenders, these direct lenders, these non-bank lenders going to crack? Is someone going to roll over? Is there going to be a comeuppance or a reckoning? Look, all markets go up, and that means all markets come down. But I'll be honest with you, my view is that, in private credit in particular, lenders have so many tools in their toolkit and I don't mean this in a negative way, but to forestall a reckoning, right? There's just so many things that you can do in terms of waivers and forbearances, holidays, whether they're interest holidays or amort holidays, whatever it may be. And I think sometimes that has a negative connotation to it. It sounds like you're kicking the can, but I'm arguing that that's actually sometimes the right decision, the right decision for the credit investor, right? It's hard, right? You don't always know. You got to make the best decision that you can. Is the issue with the business, temporary? Is some relief going to allow you to, recover principal plus, unpaid and accrued, which is ultimately my only goal, right? I don't care if there's enterprise value beyond my principal and, accrued and unpaid. I just want what I'm owed so I can take that money and go into the next investment. And that's what my investors want me to do. So I just, I think a lot of people think that that's, bordering maybe on questionable motives or bordering maybe on bad acts in the private credit industry. And there's no doubt there are bad actors. There's bad actors in every industry that do kick the can, to hide problems, and a comeuppance will come. But I don't know if it's controversial, but I'm just sort of saying, like, I think some of those tools aren't necessarily a bad thing for the investor.
And I'll say, I don't know that I'm going to find controversy in this setting, but I know from a broader press perspective, for example, there is some level of expectation of a return to earth around private credit, and that the run is over. I think there was even an article today about the 15 minutes is over, and LPs are starting to question the asset class. I think this is just getting started. Like, the shift we've seen is permanent. We'll never have credit markets. They will never go back to what they were. Private credit will always play a major role, and an increasingly major role. I think the asset class, while it reached pinnacles recently, like, it's far from completing its run, far from it.
So maybe to wrap this up, if you only had one deal to do left in your career in life, yeah, I'm going there. What would that industry be? What type of deal would it be? And maybe, Aaron, I'm asking you to find your favorite kid here between sports, media, and entertainment, because you can go Formula or you could do a movie. There go a lot of directions. So maybe, Joe, to start off with you, only one deal left to do in your life. What kind of deal would it be?
I've got to figure out how to LBO my Clemson Tigers and turn their fortunes around. I don't love them being in the ACC. They can't seem to get out. I gotta find a way to LBO that team and get them out of the ACC and extract some, put them back on the path from a couple of years ago.
Well, I'm a Tar Heel, so let me know if you can figure out how to LBO a college team. But I'd join you in that trade. I look from my perspective, Jordan, didn't not that you led me to water, but we are looking at a bunch of things that exist in the periphery of motorsports and F1. And I mean, that is an ecosystem that is global, that is, to use the word again, dynamic, really appeals to a fan base that is, well capitalized and is willing to spend money. And, it's really in its earliest days of development. So I'd say potentially something around F1, I think we're not there yet. I think there's still a lot of groundwork to be laid, particularly in the US, but that could be on the list. It looks similar to that on the sports theme. Soccer in the US is, on the precipice of really blowing up in a good way. We've got the World Cup coming. We were starting to see, some real marquee global players come into the leagues. You know, there's purpose-built stadiums, you know, being built, lots of smart money looking into how to maximize that. Again, it's a diehard fan base type of business. And if you think about some of the things that we've seen in the US and in other professional sports that have been done really, really well around, you know, fan engagement and monetization of fan engagement. You know, that diehard soccer fan base, there's lots of ways that that's going to be monetized in businesses, and that's really interesting to us. And that I think is probably further along in the US than F1, but F1 is, I mean, it's an amazing machine, not to make the car, but you know, it's a data heavy sport. There's so many ways to extract that data and turn that data into content, turn that content into engagement. And the addressable market is just so big that you know, we can only hope that we're going to be successful in finding some interesting investments there. But hey, look, we're credit investors, so we've got capped upside, so it can only be so sexy. But that is where we think there's a lot of interesting stuff cooking.
All right. Well, maybe the actual last question. If you're in an F1 car, what track would you be in? Maybe more importantly, what would your song be as you're looping around that track?
Whew, the song I got to think about, I'll tell you that I've been spending a lot of time in the Middle East. So I'd love to get whizzed around the track in Abu Dhabi. It's pretty cool. So that would be my track. The track to the song, I gotta maybe Joe can make a suggestion.
Aaron, are you doing leverage reads in 1.82 seconds like the tire changes? That's what Joe wants.
Yeah,
Aaron,
exactly.
Yeah, I gotta say, my song without hesitation is ZZ Top Lagrange. I'd go to Abu Dhabi with you. I've never been to Abu Dhabi. That has a dual purpose. Go spin around the track and then check out the sights.
Yeah, it's a pretty cool place.
Is it Abu Dhabi or Saudi Arabia that is building that track that's like 10 stories higher or something like that?
I think it's in Saudi Arabia. I think that's in Saudi. I forgot the name of it, but yeah, there's so much infrastructure for motorsports and F1 being built in that part of the world. I mean, it's amazing. It's really, really amazing.
Well, when we have our first live episode, part 2 of Entertainment Credit on ESPN The Ocho here, we will do this in Saudi Arabia or Abu Dhabi.
Yeah, exactly. Well, we just
coming to you live.
We just got the last week race in Jeddah, so we'll have to wait until the season starts again out there.
There we go. Gentlemen, this is awesome. Appreciate the time.
Thank you.
Thanks, Jordan.
All
Thanks,
right.
Aaron.
Talk to you guys later.